Okay, guys, welcome back to We Talk Money. Let's just go ahead and jump right into it. Travis, Nikki, how screwed are global economies and investors right now?
Doesn't look great. It doesn't look great out there.
I think it's
uh,
important to mention that there's a big difference between financial markets like the stock market and Bitcoin and the economy or economies. And I just wanted to kick this off, jumping right into what is on everybody's mind, which is what the hell is going on? What are the possible outcomes? Are we going into a death spiral, into a recession or depression? Um, are they going to figure this out and the tariff war will quickly subside and markets will bounce and be back at all-time highs before you know it? Are we headed lower? I know we touched on some of this stuff in the last show, but since then things have gotten even a little more rocky. So let's talk about, I guess, what's changed since we talked about this last. And, again, it changes day by day, hour by hour, even minute by minute with rumors coming out. Like, was it yesterday or the day before? There was some fake news that, there was a 90-day pause on all the tariffs. And then it was like, psych, we're actually jacking them up even more. And the trade war just continues to heat up. So, yeah, where are we, guys? Just take it from there.
I mean, we're definitely in a period of high volatility and high uncertainty, and there's a lot happening out there, like you said. Like on a daily basis, we're getting a lot of headline bombs, we're getting a lot of head fakes, we're getting a lot of different opinions on what's going on, and I think ultimately, I think if you really break it down, I mean, I think uncertainty is going to be bad, not just for investors, but it's going to be bad for Main Street as well. And we're already starting to see some of that. We had the Delta Airlines Q1 earnings out today, and Delta's basically saying that they're seeing travel demand falling in real time. We know that, we've got another Friday measure of consumer sentiment. I'll be very interested to see that. I think that's probably going to continue falling. We've got, a lot happening in not only the stock market, but the bond market and commodities markets as well. So yeah, I just think that the U.S. The U.S. administration's decision to put out these blanket tariffs at a level that was very unexpected, and then all the retaliation that we've seen with the U.S. and China and the U.S. and Europe already is creating a very heightened risk of recession. We're even seeing that in the prediction markets, like poly market recession odds are up to like 65%. The J.P. Morgan CEO Jamie Dimon was out on an interview this morning on Fox Business saying that he thinks that a recession is likely if we continue down this path. And so I think that it's definitely high uncertainty for both investors and Main Street. I don't think you can decouple the two, even though the Trump administration says, it's fine for Wall Street to have pain and Main Street's going to be fine. I just don't see that scenario playing out. So there are some off ramps. There is potential for this to get better, but I think right now, as it stands today, given all the facts we have on the ground as of today, it does not look great as far as trajectory for the global economy and global markets.
Yeah, if we just take a look, I mean, these are the headlines that we're seeing. All the big boys are coming out to play. Jamie Dimon says recession is likely outcome of the tariff upheaval. Ray Dalio sees a once in a lifetime collapse in economic and political order. So who else? I mean, there were several. Bill Ackman, which usually he's kind of like a market bottom indicator, so not really sure what to make of that one. But yeah, do you guys think this is a once in a lifetime collapse? Do you see this getting fixed quickly? What should people be thinking here?
We do have some interesting pieces of data that we can look to. And when we look at the speed of the sell-off in markets, when we look at things like the VIX, spiking over 50, there are a lot of indicators that suggest that there is some severe impact on the level of, say, a COVID or even, I don't know if we're at GFC type of levels yet, but certainly, fall of 2018, COVID panic, the sell-off has been rapid. And I think at one point, with the S&P and the NASDAQ, there was I think early this week, one point where they were potentially going to be down more than 5% 3 days in a row. And that would be the first time ever. Now, the market did rally a little bit after it opened down 5% on that, I think Monday or Tuesday. But clearly what we're seeing here is high levels of fear and uncertainty. which does mirror some of the past crises in markets that we've seen. So it's not like nothing's happening out there, right? This is pretty significant, and we're seeing, for instance, things like crude oil, even in the commodities markets, down 21% year to date, down another 4% today, down 35% over the past year. We're seeing gold hitting new all-time highs. It's happening across asset classes. So there are big shifts happening here. And so while on the one hand, I always say, we shouldn't necessarily panic as an investor. We also have to wake up to the reality of what's going on in markets, and things are being repriced for a new world order. So that is happening. And if you want to fade that because you believe we're going to get a bunch of trade deals and this thing is just going to reverse in a month or two, that's certainly one viewpoint you could take. It's not the viewpoint I'm taking, because I do think the administration is digging in their heels. I think this uncertainty will cause some economic pain, and I think we're just going to have to get through this rocky period, and it could be a while.
I think if we bring this back to corporations, a lot of, I know the goal is to bring manufacturing back to the US, right? But the reality is a lot of corporations are probably going to have a hard time making these huge decisions and investing in moving manufacturing to the US, because in 4 more years, this could all change, right? And that is something that we're just going to have to wait and see if these corporations just kind of hold out and just deal with it, or make big moves. But I'm having a hard time imagining Nike and Lululemon and a lot of these other, major retailers moving manufacturing back to the US anytime soon, even with tariffs on the table. Trav, do you have any thoughts on that? Do you agree that these corporations are unlikely to make those moves, or do you see that potentially happening?
I do see a path here where we don't get the worst case scenario, because the U.S. is trying to make deals with, say, Vietnam and Japan and Taiwan and places like that already. There are talks that are ongoing now. And so if they can get the right deals worked out there, then they could at least minimize the impact on supply chains in part of Asia. Now, I think the real concern is going to be U.S.-China. The U.S.-China relationship continues to break down. We continue to see retaliation between the two countries. There are levers that the Chinese can still pull. Could they delist China stocks, or could the U.S. delist China stocks? That would be a massive hit to global wealth. Could the Chinese sell U.S. Treasury bonds? There's some rumors out there that are already doing that. If you look at the long-term bond yields on 10-year and 30-year U.S. Treasuries, just in the last 48 to 72 hours, they've risen dramatically. And that's offsetting that goal of the Trump administration to get yields down, to improve borrowing costs. And so these are things that don't look to be they don't look to have an easy fix. So the U.S.-China relationship, I think, remains strained and could even get worse in the short run. But, if we're thinking about businesses, like you said, retailers, if they could shift, some of that production in the short run to places like Vietnam, I think you're right, though. It's going to be very difficult to actually shift production in any kind of near-term time frame to the U.S. for companies that have outsourced a lot of production overseas, especially in areas like apparel manufacturing or electronics manufacturing. It's just not realistic to believe that they're going to have the capital to do that if we go into a recession, or they're going to have the desire to do that, given all this uncertainty around the administration, when you could have a different administration in 2 years with midterms, or you could have a shift in power, obviously, in 4 years at the highest level. So yeah, I don't, if you're a business planning your production, I could see the case for shifting to some of those other regions that have existing capacity, but I don't see the case as much for actually spending billions of dollars to reshore everything. And you're just not even going to be able to do that in a very short time frame in most cases anyway. So it's a real pickle. It's a real pickle for companies, and I think that's why we are going to see. We have Q1 earnings actually coming up. Q1 earnings reporting season kicks off here in really like the next week or two, and it's going to be very telling to see what happens as far as guidance. Delta, for instance, today said that they are not going to give annual guidance, and I think that's what a lot of companies are going to do. They're just going to have to pull guidance because of the uncertainty, and I think there's going to be cuts to EPS estimates. So again, this is something that's going to be a real major headwind for companies and for stocks. And I think at some point, right, some of these stocks are going to sell off, and you're going to get to a price where you've actually priced in a recessionary outcome, and they can be defended on a valuation basis. And I've already seen some stocks hitting those levels, but that's not true of the market as a whole yet.
I want to touch on the EPS thing real quick, because if we look at 2024, basically if we have zero earnings growth for 2025, the market is still not cheap, which is kind of the scary part, right? Because it just means we could potentially have a lot more downside ahead. Usually in a recession, we see much lower forward, PE ratios. So as much as 20% feels like a lot, and I'm trying to compare this to like COVID, where our economy completely shut down, and maybe it's a bad comparison and it just won't work that way. But I feel like 20% down already feels like a lot. And we do have the potential to see more based off of the fact that we don't see earnings growth, or we see very little earnings growth. The market is still not really cheap at this point.
And you may have significant earnings cuts at some companies, especially ones that, do source out of China or do source out of places outside the US. And so I know Goldman has put out some early estimates out there. Like if you look at a grid of different scenarios of forward PEs for the S&P 500 versus EPS scenarios, I think, you can see basically that if the U.S. market derates back down to, say, 18 times earnings, which is not, I would say, screaming cheap. Like we bottomed at 9 times in the GFC. But let's just say we go from, where we've been trading at 21-ish times earnings to like 18 times earnings. And earnings do have a recessionary fall. And so they actually go down, 5 or 10% in aggregate this year. You could be looking at like a $4,000 target on the S&P, according to Goldman, if you do have a recessionary impact on earnings and then a slight multiple re-rating. If you were to go down to something like 14 times earnings and have a recessionary impact EPS, you could be looking more like 3,000 on the S&P. So that doesn't happen overnight, obviously, but the potential is there for the indices to trade quite a bit lower if we really do go into a recession, and if the U.S. loses its status as like, the stock market for global investors, and that equity risk premium that the U.S. has enjoyed, the very low equity risk premium, very high valuation multiple, that is in question now. That is in question now that we're alienating all the other global investors and our friends and allies. So it's definitely something I've been thinking about, is like maybe we have lower yet to go based on a recession and a multiple re-rating downward. That is a potential scenario.
And the technicals are really reflecting that right now. I mean, when you look at the S&P 500 daily chart, the technicals are weak. Buyers are having a really hard time here, even attempting to keep this market up. And so that's kind of making me think maybe we do have another washout ahead, especially as these headlines between China and US, that's really ramping up, it seems, and not cooling down. So I think between the PE ratio, re-rating, earnings estimates down, between the technicals that we're seeing in the S&P 500, bracing for impact is probably a good idea right now. So where do you hide, Trav? I mean, it seems like bonds aren't really a safe haven at the moment, so much, right? They're not really hedging
not long term.
in the and
long-term bonds. Yeah, long-term bonds
Yeah.
have not been a safe haven, but short-term bonds
they're
have
holding
been somewhat.
okay.
Yeah.
So where are you hiding? How are you hedging this? Well, I mean, what's your plan, assuming that we could be seeing more downside from here?
Yeah, I mean, I think cash and short-term bonds are definitely playing a good role. Like I've still got a significant percentage there in my portfolios, even though I have been nibbling on some stocks that I think have gotten oversold. But gold's doing really well. I mean, that's basically the only other hedge that appears to be doing super well. I think at some point you could have the shift towards like European equities gain some steam, like we saw at the beginning of the year. European equities have sold off in this most recent sell-off because it's probably also bad for Europe and just the global economy to have this massive trade war. But I do think at some point, as things stabilize a bit, even if the U.S. is kind of in a grinding bear market for a while or a grinding recession, I do think Europe could actually have some relative outperformance for the first time in a long time. So that would be an area that I'm definitely looking at. Maybe even other Asian markets. I mean, China's kind of a no touch right now for me as a U.S. investor, just given the risk there. But maybe something like Japan, where stocks are still pretty cheap, or even potentially maybe, I don't know, South Korea or some of the other markets there. So I'm definitely going to be looking towards some more international exposure to kind of diversify as we get further into this. It's really hard though too, because like in the short run we can get really oversold and have these huge bounces here in the U.S. market as well. And so like it's hard because you don't want to get like too bearish after like some really nasty sharp falls, but at the same time, I still see the situation as, you know, potentially having more downside, like if you look out on a 12 or 18-month basis. So I'm trying to like tactically trade some stuff short run where I actually could get bullish when everyone gets too bearish, but also remaining like overall cognizant of the fact that like this could have some very long-term ramifications that are negative for the U.S. markets.
Yeah, one thing I wanted to add too, another asset class that I expect to perform very well this month, which is managed futures.
Mm.
So I talk about this from time to time. It has historically been my best hedge in bear markets. And so, like for anybody that doesn't know, in 2022, the markets were down. What were they down on the year in 2022? Remember? Like
20 something,
22%,
yeah.
20,
yeah, it was in the
25%.
20s, right? Yeah.
Yeah.
So the managed futures accounts on average were up over 60%. So that was a huge hedge. And it's typically when you get these like fast sell-offs that those perform very well. Now they are they trade basically like a hedge fund. Like I only get updates once a month. So I have no clue how they performed this week. I'm just fingers crossed hoping that they do what they're designed to do, which is act as a good hedge. But I also wanted to talk about, Trav, to your point about like nibbling on some dip buys, like I've started to do that on Bitcoin. And right now, Nikki, I know you said the chart is looking weak, which I agree. Very short term, right? We have this just aggressive leg down. So we had the run, and then we used the 200 period moving average as resistance, and then fell off a cliff. We are at multi-year support. So the high of December 2021 is now turned into support. So this is potentially an area where we could get a V bottom, and what that would look like is kind of similar to the COVID crash, right? Where we had this a very, very aggressive sell-off, right? And if you're watching the video, you can see I've got the chart pulled up to, mid-March 2020. If you were only looking at this price action on this sell-off, yeah, this looks scary as hell, right? But what ended up happening is we basically just climbed the wall of worry, and then eventually, just a few months later made a new all-time high. So, I definitely want to think about the risks and recession, and, think about like, the impacts on the actual economy and how that filters down to earnings and obviously valuations. But also I wanted to talk about like, what is a potential surprise, bull case here? Like, is that on the table? And have you guys thought about like, a probability wise, like, is it even 5% or 50%? Like, what is the maybe the white swan here where things actually get figured out pretty quickly? And is the damage already done? Are we too far into this? Or if, and again, it depends on who you ask or what source you're getting your news from. But, there are some people that are showing that countries are coming to the table and renegotiating. Like, what if that does happen quickly? What is the bull case, if any?
I think, yeah, you said the key word there, which is quickly. The more quickly it happens, the more potential there is for a stabilization. And so you kind of laid out what I think is the bull case right now, which is that a bunch of trade deals get struck. And all of a sudden we go from having all this uncertainty to now actually maybe even better trade terms than we had before all of this started. Particularly for the U.S. And so that's definitely a bull case. And I think that's where, defenders of the tariffs still believe the bull run's going to come from. But like I said, quickly is the key word, because the longer this goes on, the more uncertainty you have, the more pullback in business investment you have, the more pullback in consumer spending you have. And as we know, that all has a significant, sort of like self-fulfilling effect, because it's that reflexivity that we see where, like in any deep recession, like you have small cuts to business investment and consumer spending, and then all of a sudden that feeds on itself and it becomes a self-perpetuating mechanism downward for everyone to pull back. If so, as we get more and more uncertainty, and if this drags on through the summer, and we have, you know, manufacturers and small businesses shutting down or raising prices massively to try to maintain profitability, and then consumers pulling back because prices are so high, then yeah, you're going to have, I think, a pretty tough scenario to work out of, even if you get trade deals, you know, later on in the year or whatever. But if those trade deals come in the next 2 or 3 weeks, and you can minimize some of the damage that's been created, some of that uncertainty, then I think maybe there's a case where, you know, you work yourself out of this quickly. I do think, like I said earlier, though, the U.S.-China situation seems like it's going to be a little stickier, a little thornier. It's going to take a lot longer. The U.S. administration still sees China as an adversary, so that's something that I don't see how you get a quick resolution. Now, if you did get a surprise quick resolution, that I think is maybe a white swan bull case scenario that nobody's expecting right now. So
Yeah.
don't.
And that's why I don't want to ignore that, right? Like what in times of fear, it's like everybody just gets like, I feel like they put blinders on and they only see the downside potential. I'm like, well, what is the counter trade here? And is it foolish, or is there a decent enough probability to really take some swings? I know you guys have been buying dips and allocating capital, and so have I. Um, that's the thing, right? When you're trying to catch a falling knife, where does that knife actually stop?
Well, there's risk on both sides, right? A lot of people right now are wondering, crap, what do I do? There's all this uncertainty. The market's down to almost 20%. Do I buy this dip or do I wait for more lows? And there's truly risk to do, you know, both. There's risk to waiting for a trend confirmation, waiting for bottoming signs, and for technicals to actually show that the buyers are in the market and they're able to hold the market up, and you pay for that confirmation before you start, you know, allocating capital. The risk to that is you're missing some of the best bounce days, and so that's the risk. Now, the flip side of that, and the other thing you can do, is buy as the market goes lower and lower, and just kind of scale in as slowly, and buy as the market continues lower. But the risk with that is more downside. So you can't win. You can't really win. You have to just choose, and you can even do a mix of both. You can scale in with some of your capital on the way down, and then choose a certain percentage of your capital to allocate once you get that confirmation of a trend shift. So you can kind of mix and match these two strategies. But I personally love the scale in approach. That's how I've been managing this market recently. I'm still allocating capital, but not all of it. And I really don't want to put myself in a situation where we do get that white swan headline. We saw just the other day, I think it was Monday, that fake news headline. The market was roaring, bouncing hard. And it's like
Looking
that.
for a reason. Yeah.
Yeah, it's like that. Just people have capital to allocate. Not everybody, but there's a lot of money market money. There's a lot of people looking to buy cheaper stocks that have been in cash. I've talked to many people that have been sitting in money market and treasuries, you know, because they've been so afraid and they've been waiting for this dip, and here it is. So, you know, I think about those things, and I don't want to miss out on that white swan headline that's going to completely shift this market trend. So just choose it carefully, choose your strategy carefully, do what's best for you, but you can also mix and match strategies. And I like that idea too.
Yeah. Yeah. My gold, I just ran the numbers. The gold position that I moved into a decade ago went from like low single digits to now like high single digits. So in a way, that's also acting as a hedge. I forgot to mention that, but
And that's good. That's great. But the problem with gold, you know, over the long run, is people that have had too high of an allocation to gold have missed out, have had opportunity costs of not being
oh yeah,
invested in, you know, equities or risk assets, even Bitcoin, so to speak. So it's
yeah.
like a lot of people are looking at gold and they're like, damn, why am I not all in gold? Well, look, that would
I
have
just
really
ran
screwed
this.
you over the
Yeah,
long
like
run.
the 10-year CAGR of gold is just at 10%. So it's not terrible. And
No.
certainly, you know, this run over the past year is really made that basically double. Before that, I think it was in like the 4 to 5% CAGR range. So like it's not that great of a performer, but in times like right now, that's where it actually works.
Yeah,
Right. And you
getting
have
much
to
more respectable at this point.
yeah,
Yes. We
it's
still make
doing its
fun of
job.
Peter Schiff, but at least he is a little bit right this year. So but yeah, I mean that, talking about Bitcoin, it's like, well, what the hell is Bitcoin doing? Why is it not at all-time highs? And I think it's, just acting along with stocks. I mean, pretty much directly correlated with stocks.
But better. But
But
better.
better. Yeah.
It has shown some resilience. It has shown some resilience, which I think
Yes.
is interesting.
I've
It's
been
higher
impressed.
vol. It's got the best CAGR over the past 15 years or so. So we all know. I mean, I'm a Bitcoin fan. I've got a huge Bitcoin position as a percentage of my net worth still. But yeah, I mean, I'm sitting here every day. I look at this chart where it's a correlation between the NQ, NASDAQ 100, and Bitcoin. And I'm like, Bitcoin, please wake up, do something. Like I'm poking it with a stick. But right now there was so much hope going into the election, went from 70 to over 100 in a short period of time, and then now it basically did a round trip to the election prices. So that's kind of common, stair step, run, retracement, extension to the upside. And today, actually, Treasury Secretary Bessent came out and said some very bullish stuff about crypto in the US. I don't think I can get the audio to play here, but basically, yeah, just saying that, reaffirming the idea and the words that Trump has said that, the US wants to be a leader, and we're going to look at a lot of the regulatory impediments that have been holding Bitcoin and crypto back in the US. So I think that even though there's all this like scary tariff stuff, like there's still positive developments and movement forward, not just in the US, but globally with Bitcoin and, dare I even say, crypto. So there is a light at the end of the tunnel. I think no matter if we see a COVID-like V bottom bounce or a extended recession, I mean, long term, I'm still bullish on humanity, and I'm still an investor. And so I'm always looking for things like this as evidence that Bitcoin for me is still a much just awesome asset to be invested in. So
Chris, I'm actually seeing some interesting confluence between what's going on in the S&P 500 and Bitcoin right now. So if you look at the corrections we've had, or the bear markets we've had, 2022 was a 50% Fibonacci retracement from the major move we had. 2018 was a 50% Fibonacci retracement as well. 2020 kind of messed up the trend, but 2020 was a little crazy with everything shutting down. So I'm kind of taking that out of the mix. But when you think about the fact that we are currently in the S&P at that 50% fib retracement, which we bounced off of in 2018, and we're following 2018's technical pattern, technical play, right?
yeah.
Which we talked about, I think, in the community, we talked about that. And Bitcoin is at a major support level, resistance turn support level around 74,000. So I kind of feel like
let me just explain what you mean by fib pullback. So
yeah,
for you guys that are just listening to the audio, what we do is if you look at the pivot low from October 2022, that was the start of this macro trend to the upside, this big trend that topped out in February of this year. And we look at that as a leg, and then you measure the pullback, you can see different Fibonacci retracement levels. And right now, just this week, we had tagged the 50% level, which is a major pullback zone. I call it the sweet spot zone in between the 38 and the 61 and the 50. I mean, think about it, it's just a halfway point. So that is just where a lot of algos are kind of set to buy. And I know individual traders and investors also like to buy at those levels. So I think that's why we've seen that pause there so far.
Yeah, and 2018 was the same exact scenario. And so I just find it interesting. I kind of feel like we're at do or die zones with Bitcoin and the S&P at the same exact time. If we end up breaking down through the 50% retracement zone in the S&P 500 and breaking this support in Bitcoin, I think people are really going to get spooked. And that, I think, is where maybe people that have money to allocate are going to need to really pay attention, because those could be great opportunities into that fear. Remember, be greedy when people are fearful. Truly, that still stands today. So I think if we see those zones snap lower, it's going to get ugly in the short term, but something to watch, as they're
Yeah.
both assets are kind of teetering on at that zone.
Yeah, so we've talked about the TA on stocks and Bitcoin. When it comes to rates, I wanted to ask you guys just a little more about this. So we saw this like kind of capitulation where, was it last Friday, the Trump administration was bragging that rates were collapsing, and I think it was even Trav's favorite person, Chamath, was saying, "Hey, look, it's working," right? And then it immediately like ripped in their faces. Do you think this is an accurate barometer, or what should we be looking for in bond yields for anybody that doesn't really focus on that every day?
Yeah, I mean it's a pretty scary situation to see yields coming untethered and spiking to the upside when you have everything else selling off, because bonds in a crisis are supposed to play that flight to safety role. But long-term bonds, in particular long-term treasury bonds, we've seen yields make a huge move just in the last, like I said, 48 to 72 hours, and that has completely reversed one of the things that was helping soften the impact of the trade wars, which was declining yields. And so yeah, the Trump camp was like, oh, we're gonna bring yields down, make refinancing cheaper for the housing market, improve the housing market. We're going to make refinancing cheaper on our own U.S. Treasury debt. Well, that's going to go out the window if rates are continually moving higher, and so that's another leg of the stool kicked out from under them, so to speak, in terms of this policy move. I don't know where this is going to end up. I'm very interested to see what happens today and tomorrow. We have some Treasury auctions. By the way, I think it's worth pointing out that people that say, oh, we're going to refinance all our debt in one slug like it's a mortgage, that's not how this works. So U.S. Treasury bonds and bills get refinanced on an ongoing schedule, weekly, monthly, all throughout the year. So this thing happens not all at once. And so, like, again, today, tomorrow, we actually have some of our weekly treasury auctions, and it's going to be very interesting to see what the demand for that looks like, and if yields get pushed up even further. If we get into a crisis situation where long-term bond yields start to really go parabolic, that's going to just put further downward pressure on other asset classes, and it's going to put further pressure on asset managers, pensions, and so that could create a lot more stress in the market. This has the potential to get really bad, and so we're watching that very, very closely. The bond market matters a lot here. Of course, we also haven't really talked much about the Fed. But the Fed is watching this very closely, and the Fed could step in and buy some of those longer term bonds to try to contain the yield spike. But they don't want to do that right now. The Fed does not want to play savior to this market right now. In fact, there was an article out, I think, from Nick Timmeros yesterday talking about how tough of a position the Fed is in, because if you do have price spiking in the near term, consumer prices spiking because of all these tariffs, then the Fed is going to find it very challenging to actually lower rates. If the market and the banking system needs lower rates, but then we've got inflation happening. I mean, that's a stagflationary situation, and it's really difficult for the Fed to act and lower rates in that scenario. So the Fed is in a really tight spot, and it's probably not going to be able to be the savior that the market may need it to be this time around, especially if we have bond yields spiking on the long end.
Okay, well, we'll keep a close eye on that. What else outside of just the tariff talk should people be looking at right now? Just trying to think what other big news events are coming out over the next week. Other big headlines. I know the Doge situation. There's been a lot of controversy about the lack of true cuts, I guess. Is it really moving the needle? I don't know how much that's going to impact investors. Anything else you guys are thinking about or looking at?
Yeah, so the Doge savings have certainly slowed down a little bit in recent weeks. The other thing I think that's interesting is, now the Trump administration is calling for an increase in the defense budget from, I think, 700 or 800 billion a year up to as much as $1 trillion a year. So it's like, okay, well, if you're going to cut out, I think Doge claims they've cut out 150 billion of annual savings so far to date. Well, all of a sudden now you're increasing the defense budget by that much or more. So it looks like, I don't know, fiscal deficits, are they really improving here under the Trump administration? Where are they going to actually cut the budget?
Yeah.
So, maybe that's actually good for U.S. growth if we don't have a massive cut to the federal budget and you don't have like what is essentially austerity. But on the other hand, that's probably not good for bonds if if you have the deficit continuing to remain at ultra high levels. So yeah, there's a big question there. There's a big question in my mind about, what does the budget deficit ultimately look like under this administration? There's all these like moving parts, and they also want to do tax cuts or extend existing tax cuts. So that's going to add to, the federal debt pressure. And then also potentially if we go into recession, federal revenues go down. And so you could have the deficit blow out. So it's not just the Fed that's in a tight spot. I think the administration has put themselves in an extremely tight spot. And so, man, I sound like such a bear today.
Hey, I mean, it's important to look at it from all sides, and I mean, yeah, this is the reality of the situation we're in right now. So, Nick, what are some questions that you've been getting from some of your wealth management clients? Are there any themes or anything that, just common questions that people might be having that you've been hearing lately, or?
Honestly, I've just been getting asked my thoughts on this whole thing and if it's over or not. Are we going to come out of this okay? Is this the
Yeah.
beginning of the end? And I think most of my clients are DIYers. They've been through many, especially crypto DIYers that have been through some pretty bad market cycles. So I will say that this is kind of a walk in the park for some of my clients in the crypto side. And most of them are in that space. So to me, what's happening in Bitcoin is actually mild compared to what we've seen. But I've been telling people that historically we've seen some pretty bad shit, for lack of a better word. We've seen the housing market and the financial markets implode. We've seen the whole entire global economy basically shut down. We've seen a Great Depression. We've seen recessions along the way, throughout the decades. We've seen policy errors that have caused implosions and issues over the decades as well. And somehow levers get pulled and things recover, right? Historically, that's what's happened every single time. Do I think that I don't think this is anything to brush under the rug at all, but I also think that we have for a long time been trying to tell people and prepare people that recessions and bad times and bear markets have historically happened and they will happen to you. It's going to be very difficult to be an investor for decades and not see a bear market or a recession. When I think back on the great financial crisis, that was a really freaking bad time. Like that was a lot of people got super duper screwed during all of that. COVID caused businesses to shut down completely. People lost their thriving businesses. Of course, there was a flip side to that with stimulus. But the point is government, basically fiscal and monetary policy exist for a reason. Will levers be pulled eventually? Are they going to run this really into the ground and completely destroy the best economy in the world? I highly doubt it. Eventually, egos will have to be put aside, is my guess. So, not to be like a super optimist or anything, but we've been in bad times before. And this is one of those times that we talk about, we tell investors that it's possible. So, if you can't handle that, it could be for a reason. Maybe your financial plan is not properly planned out, or you don't have certain, emergency funds in place or different backstops in place in your financial life to where you can sustain and handle these types of environments. That's the core of the issue here. People that are feeling fearful, people that are afraid, people that are wanting to dip out of the market. Maybe you need to rethink your whole entire plan and why you're investing in the first place, because these things happen. So
Here.
I don't know. That's my soapbox. That's my
I love it.
soapbox.
I'll mirror your point about, prior panics or market crashes, whatever you want to call them. I was thinking through this on X the other day. I said, which market panics can you remember like they were yesterday? And for me, there were really three that came to mind. It was, yeah, the GFC, specifically the day and the week that Lehman imploded back in '08. That was, in the depths of the GFC. And that I think was really just like an oh shit moment for a lot of people. And then it was a lesser known one was the flash crash in 2010. It was short lived, but I remember Nikki and I were in Argentina having coffee in a little town square, and we started getting alerts, and we looked at the charts, and the markets were just absolutely imploding, and Kramer was on TV going nuts. And like, you have these moments, and that one was actually caused by algorithms. And then obviously like the COVID washout in 2020, that if you think back to market sentiment and just the mindset that people were in, they were like, well, this is it. This is over. This is the crash. This is the crash, and the economy is not going to come back. And, that actually was the bottom. And so what I was thinking about is how all three of these things, even if they weren't the exact low in the markets and price, they were insanely profitable times to either be actively trading and or dip buying. And so there's always a narrative. There's always a reason why this time is the end. But yeah, I mean, I'm an optimist as well. And I think that, cooler heads will prevail. Is it today or a year from now? I don't know. Hopefully this doesn't get too terribly bad. But even if it does, that I don't think this is the end, and I'm a dip buyer right now, and I'm going to keep buying the dip. So
I bought some of my most profitable investments in 2020 during the crash and 2018. Trav, you were there for both of those alongside me, and I remember you were doing the same thing too. If you are an investor and you have capital, these are, I hate to say it, but these are good times to be an investor and a trader. And I know that there are people that are going to be struggling, and life is just kind of crazy and unfair right now, it feels, for a lot of people. But we're talking to investors here, and I think getting too emotionally involved with this and not really thinking about historically what has happened and what could happen in the future. I just know these are times we make money and build wealth. That's all I know, based off of same thing what you said in your tweet.
I agree. And even though I'm today's resident bear, I actually 100% agree as well. I think these are times where you actually make wealth. It doesn't feel like it today, but if you fast forward like 2-3 years from now, if you make the right decisions during like these periods, like you end up realizing that these are when like, the significant gains are actually made is in making good decisions and buying things at the right time, like during these types of panics. But I don't know. I just kind of hope that we get like one like really, really significant deep panic out of this, like a like a limit down day where not only does it create amazing buying opportunities, but it finally the market finally punches the administration in the face into capitulating a little bit and at least getting some like deal signed or something like that. So maybe
yeah.
we need like a really good flush to just push everything into deal making mode. I don't know, that'd be cool
I
to
mean,
see.
if you think about it, like there's a whole generation of traders and investors that haven't really experienced limit down days, and
Mm-hmm.
like they don't know what that feels like, which is kind of crazy to think. Oh, and by the way, Trev, just explain quickly what that means for anybody that doesn't know.
Yeah, so limit down would be like, when an index like the S&P 500 is down and hits the circuit breaker, so they actually have to pause trading for some amount of time. So like the first circuit breaker is at 7% down in US markets. I think there's another one at 10, and then they actually shut the market down if it's down 20% in a single day. So after 87, they were like, yeah, I think we probably need to have some circuit breakers in place. So yeah, we'll never get an 87 crash in one day. I don't think like we had then, because they'll shut the market down for trading for the
They'll
day.
be like too. It's like how China like bans short selling sometimes.
Yeah, exactly. But yeah, it'd be
Uh,
cool. I don't know if we could get a down 5 or down 7% day here to really flush, finally, just kind of flush everything out, get to max pessimism and actually have the market. And maybe it'll take the bond market doing something similar to actually send a message to the current administration that, hey, you've got to take a different tack here. So we'll see. I'd like that. That would probably be because what I really don't want to see is just like a grinding recession slash bear market that lasts for, a year or two or three.
Like
And
a 2002, like,
uh-huh.
or yeah, where it's just grinding to the downside. Yeah, I
Hmm.
would prefer that not to happen. But
Hmm.
I mean, we're a long way into this bull market, since I guess the bottom of '09, or beginning of '09.
I mean,
But
it feels like so far the trend in the technicals is giving us a sign of the quick
Hmm.
V
yeah,
bottom future versus the grinding bear market, which we saw in 2022. That was like a grind.
Hmm.
So I think that's kind of a good sign that we're getting it done quick. And, the market is going to bottom before things get better on the headlines and before the data, right? A lot of times the stock market will bottom before the data gets bad or whatever, if it gets
yeah,
too
Trev.
low.
For anybody that hasn't heard the story of the hedge fund days, like, can you just give like maybe a 1 or 2 minute story on how that played out in the GFC when you went into the hedge funds?
Yeah, 2008, it was a really interesting. I almost said fun. It was not fun. I think I look back on it more fondly than it actually was. It was very, very stressful. Um, but I see some people, especially that weren't in the market then, making comparisons with this sell-off that we've had recently to 2008. It was vastly different back then. It felt much, much worse. It lasted many more months, and we had a lot of these big down days. We had 8-9% down days in the indices, and some of those were actually followed by massive up days when it looked like, oh, the Fed's coming to the rescue, or oh, the banking system's not going to fail, and then we'd have these massive whiplash moves up, and it just made it hard to make decisions, because it was like, well, do you buy the dip knowing that maybe you wake up tomorrow and all of a sudden another major bank is being taken over. So it was just constant fear, uncertainty. So in the sense of uncertainty, it's similar to 2008, but I think 2008 was a much deeper problem in the sense that the banking system was much more over levered. There were a lot of unknowns around what could blow up tomorrow in the financial system that we don't even know about. But ultimately, like we just said a few minutes ago, it actually ended up being one of the most incredible times. Like, we had an amazing, incredible year in 2009 because we had capital available to us in 2008 to actually invest in opportunities. Like, we were buying. We went into a bunch of distressed debt deals where we were buying assets for 40 cents on the dollar. We bought stocks that 5x within a year, stuff that was trading for 2 times earnings, that had like no earnings risk and things like that. So those times were just incredible times. You just had to kind of get through you kind of just had to put your head down, do the work, and try not to get, try to manage your emotions around the daily like headline bombs that we were getting. And so we're not in an environment yet that's quite as bad as that, but if we start to see stress in the credit markets, stress in the bond markets, that's where I think you get into an environment like that, where you really start to see like companies failing in mass, people being laid off in mass, the government talking about having to like, take stakes in companies. Like, if it gets to that level, then yeah, it'll be pretty bad for a lot of people. But it also, again, just even then, even 2008 and 2009, as bad as those were, you could have made life-changing fortunes coming out of the backside of those. So yeah, it's I think a really good parable to think about.
Awesome,
I
man. Thanks for
was
sharing that. Yeah.
Just a fun fact. I was looking at 2022. It took us about 5 months to hit 20% down from the highs. And we've done it now in what? Less than 2 months. So, from the highs recently. So,
Mhm.
I don't know, just something interesting to think about how quickly we've hit the 20% bear market mark. I mean, I don't think we're considered in a bear market yet, but we did get, below 20% for a brief moment there.
Yeah.
So
Yeah,
it's
we're
happening much
teetering on the
quicker.
edge.
Can
Yep.
we get one more good flush though? I want some buyer of last resort setups in stocks and Bitcoin.
Let's
I
go, baby.
mean,
Yeah.
I'm ready. I'm locked and loaded and ready.
There we go.
What's funny is, like, so for the guys and ladies in the wealth building community, the buyer of last resort is a trade setup that we've back tested on several assets that's wildly profitable, unless the asset dies. So obviously you only want to buy stuff in deep bear markets, if you are optimistic on the future of the asset, obviously. But it's interesting because Bitcoin is actually only, and it feels like it's much deeper, but from the prior all-time high in December, it's only about 30% off of all-time highs. So it's not like we're in the depths of a bear market like we were in late 2022 or 2020 or even 2018. Like we're still pretty high up. So I don't know, take that for what it's worth. But market sentiment seems to be a lot more fearful and negative than where I think the current price action is relative to prior prices. Does that make sense?
Well, it helps that Bitcoin doesn't manufacture textiles overseas.
Hey,
You know,
the good news is, have you guys seen the memes of all the fat Americans in the sewing machines? Like, we're gonna reshore all these jobs, and Asia's just looking at us laughing. Like, yeah, okay, yeah, go ahead and do that. Let's see if that works out for you.
I know it is interesting, right? Like unemployment's at like less than 4.5%, and most of our economy is in the services sector, and yet there's this desire to like reshore all this manufacturing. I don't know. I guess I just don't fully understand. I know that it sucked in the 90s and early 2000s when a lot of manufacturing plants in the U.S. went away, but at this point, given where we are now today, and we're like leaders in AI and tech and all these services businesses, I'm like, do we really want to try to shift back to an economy that we were like 30 years ago, 40 years ago? I mean, I do think obviously like for like certain critical things, like, you want to have defense capacity and maybe some chip capacity and some chemicals and energy and a little bit of manufacturing. But do we need to be making like Nike shoes here? I don't know. Does it really matter? I don't know.
Right. That's where I'm at with it too.
well, I mean, and then what does that happen to the economies in those countries? Like Chris, you've traveled the world too. I mean, you've seen a lot of these countries, and they just don't have the same opportunity in a lot of areas. And so, I don't know. I think about that too. Taking that away from those international economies.
Yeah.
I don't love that, either. It's kind of feels like a lose-lose here in a way, because then the I don't want to have to pay double for my Lululemon yoga pants or my Nike shoes or whatever. As a U.S. consumer, I don't want that. So it feels like a lose-lose, kind of.
Yeah.
We want our cake and we want to eat the cheap shoes too.
Oh yeah, like an iPhone apparently would cost $3,000 or something. They estimated it out that it would cost like $3,000 plus.
I think that's going to be the straw that breaks the camel's back. It's like as soon as Apple raises iPhone prices just for a day to like $3 or $4 grand, people will revolt en masse.
Ain't happening. Maybe they'll get a carve out. That's what people are hoping, and that's the other thing. We don't know who's getting a carve out, who's getting what deal. So there's just too many unknowns right now.
There's so much stuff. There's just the approach has been just so like haphazard. Like even now today, there's more, headlines about Trump, now targeting tariffs against the pharmaceutical industry. So it's like if you didn't have enough on your plate already, and all these deals that you still need to work out, now you're going to throw on more tariffs on more stuff. It's like, what are we doing, y'all? Come on.
Yeah.
We're trying to get yields lower, duh.
Max chaos. It's not working.
I know.
This just popped up on my feed. Talking about Nike shoes. Oh man. For everybody listening to audio, it's Trump and Elon and everybody just making Nike shoes themselves. And on that note, we'll go ahead and wrap it up. Make Nike shoes American again, I guess.
Nikes are dead. It's all about hookah now.
Oh, is that right?
Apparently. Hookah.
Well, in the next show, we'll dive into shoe stonks, Crocs, and what's the other one? Birkenstock. Nick, I think you got some Birkenstock. All right, guys. Well, anything else you want to mention before we wrap it up? I think we had some good words of wisdom there for investors and traders. And yeah, any final thoughts?
Stay calm. It's going to be okay eventually.
There we go. Yeah.
Yeah.
We
Look
don't
at
know where the low
history.
is, but yeah.
Yeah, I don't know. This is a tough one, but it doesn't matter. Nothing changes. You still have to have a cool head, stay calm, think about your financial plan, think about your entire picture. You probably don't need to be panicking out of the market right now, and it's probably your emotions getting in the way of reality. So,
And on that note, guys, thanks for watching. Make sure to subscribe to the podcast on your favorite podcasting platform and also the YouTube channel. Go to wetalkmoney.com and submit a question for the show. And yeah, Trav, Nick, thanks. And we'll see you guys next time.
see ya.
Cheers.